morning. First of all, I would like to thank the First Credit Bureau for the invitation and the opportunity to represent the Italian Central Bank here. I will talk about the Italian Central Credit Register, describing the aims, features and reporting models, service and products for our banks. And last but not least, absolutely, I will talk about CCR as source, CCR Central Credit Register, as a source of information for users of the Italian Central Bank. Let's start with the definition. The Italian CCR is a credit information sharing system, and it's managed by the Italian Central Bank. It is in the statistical department of the Italian Central Bank. CCR collects data concerning credit facilities granted by each single bank and the financial intermediaries as well to every single borrowers, natural persons or companies. Then aggregate the information and send back to each bank a return flow containing the global indebtedness of each one of their clients. It helps the evaluation of the credit worthiness of the clients of the bank. Anyway, banks can give at any time ad hoc request to know the global risk position of the new potential client before granting loans. aims for banks, good borrowers, and for the Italian Central Bank. aims for banks, as I mentioned before, there are tools, return flow and ad hoc requests that help the banks to evaluate the client's credit worthiness and helps them to have a better risk management. For good borrowers, the CCR is a way to have more credit at better conditions, because a good history in CCR can help clients to have a bigger amount of credit with better interest rate, and often it doesn't need collaterals. For the Italian Central Bank, it's really important because it helps the overall stability of the credit and financial system, because banks grant credit with more responsibility. And is, as I said in the starting point, it's most really important, it's a precious source of information, because we have a huge database with bank borrower level, and it allows deep analysis not otherwise possible. We will see at the end of my presentation some example. Now a slide regarding the reference information of the clients. For a perfect functioning of the CCR, it's important not to confuse one person with another person, one company with another company. It's important to identify correctly each entity. So we need an entity register, efficient and perfectly functioning. So the entity register is the database in which all the natural person and companies are registered with their personal data and identified with a univocal code. I say it represents the foundation of the CCR. Without a good entity register, CCR couldn't work, it's useless. Now, some words, some slides about the reporting. banks have to report to the central bank information on credit and guarantees of each customer on the last day of a reference month. It's a monthly collection. The threshold, as Oscar mentioned, is 30,000 euros. Under these thresholds, we have in Italy a private credit bureau that work till this threshold. The central credit register works over this threshold. For bad loans, we have almost no threshold. There are 250 euros. It's almost zero. So bad loans are anyway collected. Information are not more due when performing loans go under the threshold, or bad loans are cancelled by the balances of the banks of write-off. But anyway, they remain in the previous report. So even if information is not more due, the story remains. Banks with the ad hoc request can know the information of the history for the last 3 years of the new potential clients. This is I will not enter in detail. This is the reporting, the reports for each client. We collect 5 macro categories: cash credits, like mortgages or overdraft, commitments that are the guarantees issued by the bank, guarantees received by the bank in favor of clients of the same bank, also financial derivatives and other general information to give a better picture of the global indebtedness of the client. Each category is broken down by some variables that describe in more details the loans itself. So, location, if credit is issued in Rome, in Milan, in Naples, original maturity, currency, import-export, and so on. Some slides about other information, like the frequency. We collect monthly, as I said, the information, but on ongoing basis, we receive correction. When a bank detects an error, it has to be sent immediately to the CCR, and we broadcast the correction to all the other banks. So, if other banks have the same client, they know that there is a correction of the global position immediately. Services for banks, as I mentioned, personalized data return flow with the global position of each client of the bank. And at any time, banks can ask to us ad hoc requests, and these requests are subject to a fees. I'm to restore the CCR for the cost paid for processing and transmission. Some numbers. In August, we have had, you can see, more or less 500 banks in Italy that reported to the CCR, 11 millions of borrowers included in the CCR, and so on. Number of ad hoc requests in 1 month, 700,000. In the Central Credit Register division, we have only 10 data managers, so you can imagine everything is completely automated. Data managers act only when some banks act as a not correct behaviors. So in some rare cases, they have the oversee of the situation. Now, The second part of my presentation, it's on the usage of CCR data. That's an important part, as Oscar also mentioned. In the center, we have the Bank of Italy, the building that is in Rome. On the right part, the auditors of the Bank of Italy that use CCR data on-site auditing. Then we have statistical products, because we produce statistics starting from the CCR data for the public that are available in the website of the Bank of Italy. And the most important part, data after the collection phase are stored in a statistical data warehouse and are used by the internal users of the Bank of Italy for supervision, research, and monetary policy. I would underline this part again. We have a huge database, really detailed, granular and detailed, at the bank borrower level, and allows us to do deep analysis for supervision aims, research, and monetary policy. And as I said time to time, it would be a crime not to use a so huge quantity of data that we have in the central bank. And we use for microprudential supervision, for financial stability, for monetary policy, and for economic research. So microprudential supervision, the control of the single banks, and for financial stability to control the global financial system at a whole. And I will show you some use cases, some examples of the first 2 points. CCR data for microprudential supervision. I would introduce you the concept of adjusted bad loans with an example. Who knows if a bank has well assessed their loans? Who knows if a loan is performing for a bank, but for the other banks that have the same clients, these loans is non-performing? It's only a question of delayed perception. First of all, these loans could become bad for all the banks. So having data at bank borrower level, we can see the same borrower, how is considered by all the banks. If few banks consider performing this borrower, but the majority of the other bank consider the same clients as insolvent, probably this borrower will become a bad debtor soon. So we call him as an adjusted bad loans, or better, we put this client in the category of the adjusted bad loans, that are bad loans plus this kind of clients, the clients that are still performing for some banks, but with high probability will become bad debtor soon. So this category, adjusted bad loans, that is possible to build only, I repeat, if we have information at bank borrower level, so starting from the CCR data, this category, adjusted bad loans, is used by our supervisory function, our colleague of the supervision. They use this category more than the category of simple bad loans, because it's a category that is more accurate, more prudent, and it's a category that anticipates the probable future defaults. So, I read with you, adjusted bad loans have proved to be a quite robust estimate of those loans that will gradually emerge as bad loans. They provide a more prudent credit risk assessment than the one based only on bad loans, a more accurate assessment of the real quality of the bank's portfolio, based on the evaluation made by the whole banking system. And it's also an incentive for banks to more faithfully represent the quality of their portfolio. And we use this category in our indicators, stock indicators and flow indicators. You can see some example. And these indicators have proved to be more accurate, more prudent in the evaluation of the bank for, I repeat, for supervision purposes. Another example, this is my last slide, so I will be shorter than the time that I have. The last slide is about the usage of the CCR data for financial stability. For financial stability purposes, it's important to know how many performing loans will become bad loans next year, to have an evaluation of the financial system at a whole. So it's important to know also if a performing loans will become unlikely to pay, or vice versa, if a bad loans next year will become performing. It's a more rare case. Again, having information at bank borrower level, we can follow the same borrower monthly during the year and during the next years. So we can see if a performing borrower will become a bad debtor, and so on, and all the cases are likely to pay, past due, and so on. And aggregating this information, we can build the so-called transition matrix that our colleague of the Financial Stability Department use, that show, for the whole system of Italy, this is an example, but it works anyway, how many performing loans will become bad loans after 1 year. So this is it compares last year with the current year, and we can see that more or less, almost 900,000 of performing loans has remained performing loans after 1 year, but almost 10,000 performing loans after 1 year has become bad loans in Italy. That's information to evaluate, to make evaluation of financial stability. We can also see the last row that 347 bad loans after 1 year has become performing loans. Not so many, of course. It's not so easy for the bad loans become performing loans after 1 year. So this matrix, transition matrix, is possible only because we have this information, this huge and rich database with the information at the bank borrower level. This is possible because we have the central credit register. I finished. That's all. Thank you for your attention.